Look, we all want a secure financial future, right? But the path to actually get there can feel, well, pretty foggy. So today, we're going to clear the air. We are breaking down the best long-term investments, and trust me, it's simpler than you think. By the end of this, you'll have a clear map to follow. So that's the million-dollar question, isn't it? How do you actually build that financial security? It can feel like this huge, overwhelming task. But one of the most powerful answers is also one of the oldest: long-term investing. Seriously, think of it like planting seeds today for a much, much bigger harvest years down the road. Okay, so here's our game plan. First, we're going to dive into why playing the long game is so incredibly powerful. Then, we'll look at two main paths: the really hands-on approach of picking your own stocks and the much simpler method of investing in what I call baskets. We'll also cover some cool automated and alternative options before we wrap it all up with your very own investing playbook to get you going. First things first, why even bother with this whole long game thing? Well, before you put a single dollar on the line, you've got to understand the fundamental principles that make the strategy so darn effective. And this, right here, this is really the core idea. It's so tempting to chase those quick, flashy wins you see online. But history has shown us, time and time again, that a steady, patient, long-term approach is what builds real, lasting wealth. The key is patience, not panic. At the heart of literally all investing is one simple trade-off: risk versus reward. Think of it like this: super safe bets might give you small, predictable returns. But if you want the potential for those much bigger, life-changing gains from something like stocks, you have to be willing to accept more risk. Figuring out where you stand on that spectrum, that's step one. All right, let's dive into the first real hands-on approach: picking individual stocks. This is for all of you out there who really want to roll up your sleeves, do the research, and get into the nitty-gritty of the companies you're investing in. I absolutely love this car analogy. Think of choosing a stock like picking a vehicle. Growth stocks? They're your Ferraris. Sleek, fast, super exciting. They promise explosive growth because they plow all their profits back into the business. But just like a Ferrari, they come with higher risk. On the flip side, you've got dividend stocks. These are your reliable sedans. They're mature, stable companies that give you regular cash payouts. So the question is, what are you looking for? Pure speed or a steady, comfortable ride? Then there are value stocks. The best way to think about these is like finding a hidden bargain, a really solid company that, for whatever reason, the market just seems to be overlooking. That cheaper price tag can mean less risk and less potential downside, which makes it a more defensive play compared to those high-flying growth stocks. And finally, in the stock picking world, we have small caps, the potential hidden gems. We're talking about smaller companies with just massive room to grow. I mean, just imagine getting in on an Amazon or an Apple when they were just starting out in a garage. Yeah, the potential reward is absolutely astronomical. But let me be clear, so is the risk. These little guys are way more volatile, and you have to do some serious homework to find the real winners. Now, if all that research into individual companies sounds like way too much work, you are definitely not alone. And that's where our next section comes in: investing in baskets. This strategy gives you all the power of the stock market, but in a much simpler, more diversified way. So, the main tool here is something called a stock fund. Imagine instead of buying just one apple, you bought a whole basket of different fruits. A stock fund, whether it's an ETF or a mutual fund, is just that: a collection of tons of different stocks all bundled together. You buy one share of the fund, just one, and bam, you instantly own a tiny piece of all of those companies. So why do this? What's the big advantage? Well, for starters, you get instant diversification, which is just a fancy way of saying you're spreading out your risk. It's also way less work than trying to analyze dozens of individual companies. And because you own so many, your returns tend to be a lot more stable over time. Honestly, for most people, this is a fantastic way to go. Let's go back to our risk versus reward chart for a second, see where stock funds fit in. They're right in that sweet spot, that perfect middle ground. They're generally less risky than pouring all your cash into just a few individual stocks, but they still offer much higher potential returns than the very safest options out there. And what is that safer option? Well, that would be a bond fund. It's the exact same basket idea, but this time it's filled with bonds. And bonds are basically just loans you make to governments or big corporations, and in return, they pay you interest. A bond fund is a great way to generate stable, predictable income with a lot less drama, kind of like the anchor for your whole portfolio. Okay, but what if you want to be even more hands-off? Like set it and forget it simple. In this next section, we'll check out those kinds of strategies, plus a huge investment class that has nothing to do with stocks or bonds. First up, the Target Date Fund. This thing is genius in its simplicity. All you have to do is pick the year you think you might want to retire, say 2055. The fund literally handles everything else. It starts out aggressive, packed with stocks for growth when you're young. Then, as 2055 gets closer, it automatically and gradually shifts your money into safer stuff, like bonds. It manages your risk for you over your entire career. Another awesome automated option is the Robo-Advisor. You start by answering a few really simple questions online about your goals and how much risk you're comfortable with. Then, a smart algorithm builds a totally diversified portfolio for you, usually using low-cost funds. And from there on out, it manages and rebalances everything for you automatically for a tiny fee. It's basically like having your own digital financial manager. All right, let's switch gears completely and talk about a totally different animal, real estate. The single biggest pro here is leverage, which just means you get to use the bank's money to control a huge asset. The potential returns can be massive, and there are some great tax benefits. But, and this is a big but, the downsides are real. You need a lot of cash up front, it can be a very hands-on job, and you're often putting all your eggs in one single basket, which is the exact opposite of diversification. Okay, wow, we have covered a ton of ground. So let's pull it all together in our final section, your investing playbook. We're going to go over the must-know rules and clear up one crucial point to guide you from here on out. Okay, stop what you're doing for a second. This next point is so important. I really need you to hear this. A Roth IRA is not an investment. This is probably one of the biggest points of confusion out there, so let's clear it up once and for all. Think of a Roth IRA like a special container or a wrapper. You put your actual investments, your stocks, your funds, your bonds, inside this wrapper. And the wrapper itself gives those investments powerful tax superpowers, like letting them grow and eventually be taken out completely tax-free in retirement. Remember, it's the account, not what's in the account. So if we boil everything we've talked about down, it really comes to 4 essential rules. Number 1, understand the risk you're taking. Number 2, pick a strategy that you can actually stick with, especially when the market gets scary. Number 3, know your time horizon, how long you have until you need this money. And number 4, arguably the most important one, diversify. Seriously, don't put all your eggs in one basket. So there it is. That's the playbook. You know the different paths you can take, from being a hands-on stock picker to letting an algorithm do all the heavy lifting for you. The only question left is, what's your first move?